Welcome to this strategic analysis of the Mitsubishi Chemical Group, or MCG. This briefing, prepared by HDIN Research, examines the group's ongoing transformation toward a green specialty company model. We will evaluate their H1 FY 2025 performance and the long-term strategic roadmap through the lens of capital efficiency and portfolio optimization. The situation finds MCG as a diversified leader pivoting towards sustainability. However, the complication arises from cyclical volatility in MMA and overcapacity in basic petrochemicals. The question we address today is how to accelerate the shift to high-margin specialties. Our answer focuses on radical portfolio reform, specifically the pharmaceutical divestment and the restructuring of petrochemical platforms. In the first half of fiscal year 2025, we observed significant resilience in core operating profit. While the group total reached 126.1 billion yen, the performance was heavily bifurcated. Industrial gases remained the primary profit driver, while specialty materials showed a steady recovery, effectively offsetting losses in the basic materials segment. A critical risk factor remains the MMA market. Lower than expected price recovery for monomers has pressured margins. MCG has responded objectively by canceling the Geismar plant project, a clear signal of capital discipline and shifting focus toward high-efficiency production technologies to maintain cost competitiveness. HDIN Research has identified three structural profitability gaps: naphtha price volatility, regional petrochemical overcapacity in Asia, and stagnant ROIC. To address these, the group is moving away from the traditional standalone model toward collaborative platforming with industry peers to mitigate cyclical risks. MCG stands at a strategic crossroads. To unlock the targeted 460 billion yen in core profit by 2029, the group must transition from a diversified conglomerate into a lean specialty leader. The objective is clear: achieving a 7% ROIC and a 15% EBITDA margin. The Selection and Focus's roadmap for 2024 through 2029 rests on four pillars: high-value semiconductor material investment, the divestment of non-core assets, petrochemical restructuring, and a radical cost reform program aiming for nearly 200 billion yen in savings. The transfer of Tanabe Mitsubishi Pharma to Bain Capital is a landmark event. Valued at 510 billion yen, this divestment allows MCG to exit a high R&D intensity sector that lacked core material science synergies, providing significant liquidity for the green transition. The semiconductor segment represents a primary growth engine. MCG is doubling photoresist polymer capacity in Japan and expanding synthetic quartz production. These moves align with the global surge in AI-driven demand and high-purity fabrication requirements. In the mobility sector, MCG is strengthening its battery material value chain, particularly in North America. By integrating CFRP composites and battery electrolytes, the group is positioning itself as a critical supplier for the next generation of electric and autonomous vehicles. Financial health has improved significantly. The net debt-to-equity ratio fell to 0.83 in September 2025, largely due to the use of divestment proceeds to deleverage. This provides a buffer against global interest rate fluctuations and improves overall balance sheet strength. Operational excellence is now being measured through ROIC-driven management. This includes a, zero negative margin pricing policy and the use of digital dashboards to optimize working capital. The goal is to more than double the current ROIC by the end of the decade. From a regional perspective, MCG views the Asia-Pacific region, including mainland China and Taiwan, as a unified growth core. The focus remains on display and semiconductor materials, where the group maintains a strong competitive position despite regional supply chain shifts. Sustainability is being integrated into the core business model. With a 100 billion yen investment in fuel conversion and a focus on circular economy initiatives like PMMA recycling, MCG aims to transform environmental compliance into a market differentiator. Industrial gas continues to serve as the group's, steady anchor. High margins and resilient demand in the US and Europe, combined with new contracts for next-generation semiconductor fabs, provide the stable cash flow necessary to fund more volatile growth segments. This profit bridge illustrates the internal versus external drivers. While market factors and the MMA crunch removed nearly 35 billion yen from the bottom line, aggressive internal cost structural reforms added 26.5 billion yen, showcasing effective management intervention. The Life Solutions segment focuses on essential chemistry. By expanding capacity for emulsifiers and high-performance barrier films, MCG is addressing global trends in food safety and waste reduction, sectors that offer stable, non-cyclical growth. Looking ahead to the full year, the forecast has been revised slightly downward to 250 billion yen in core profit. This adjustment reflects the reality of ongoing petrochemical weakness in the second half, though the dividend policy remains firm, signaling confidence in cash flow. By 2029, the group expects to operate as a fundamentally different entity. Success will be measured by the achievement of a 460 billion yen profit target and a significant expansion in EBITDA margins, marking the end of the structural reform phase. In conclusion, HDIN Research observes that MCG is successfully shedding its conglomerate discount. While headwinds in basic materials persist, the specialty engines in gas, semiconductors, and mobility are gaining critical mass. The path forward is leaner, greener, and more focused. Thank you for reviewing this analysis. For more in-depth market research, technical sector reports, or customized strategic inquiries, please contact HDIN Research at sales@hdinresearch.com.